Good evening and a warm welcome to all. I'm Mridul Mishra and on behalf of K Ratings, welcome you to our today's webinar on demand resurgence. Is the cement sector back on track? We sincerely appreciate your time in joining us for this webinar. Please be informed that we'll be having a Q&A session at the end of the panel discussion. In case of any queries, you please key in the questions in the slot provided. May I request Mr. Amod Khanorkar, who is the Senior Director at K Ratings, to take over the proceedings, please.
Yeah, thanks, Mridul. Welcome all to this Care Ratings webinar on cement. Thanks a lot for joining this afternoon. Today, we are also joined by guest speaker, Mr. Aditya Saraogi of Birla Corp. Mr. Saraogi, welcome to you. Mr. Saraogi is a chartered accountant and is a CFO of Birla Corp Limited, which is a flagship company of MP Birla Group. Prior to joining Birla Corp, he was with the Indian Associate of Firms such as of Ernst & Young, BDO, when he served several large clients, including ITC, Bharti Airtel, Lafarge, Peerless, iGate, and Reliance Communications. So welcome to Mr. Saraogi once again. We are also supposed to be joined by Mr. Toshniwal of Wonder Cement. He unfortunately could not join due to the last minute exigency, so apologies for that. In terms of agenda today, what we do is this. After my initial thoughts, my colleagues Urvisha and Radhika, who are my cement experts at Care Ratings, they will take you through a detailed presentation. Post which we'll have dialogue with Mr. Saraogi, and at the end we'll have a Q&A session with the audience. Coming to the webinar and the agenda here, as all of us are aware, India is the second largest producer of cement, and it's also the consumer. In India, the sector has largely benefited because of the thrust given by government on infrastructure sector in form of policies, reforms, and budgetary allocation. The outbreak of COVID-19, no one really expected that, but outbreak of COVID-19, as with other sectors, played havoc with cement industry as well. It unfortunately came at a time when the activity for cement sector and the construction sector is generally at its peak, that is pre-monsoon. The operating rates for the cement players, they fell down to all-time low, and on YOY basis, they still continue to be low. Nonetheless, during the pandemic, somehow, cement consumption has been gaining traction in rural and semi-urban markets. And that's been sort of a redeeming feature. Subsequently, since the economy was unlocked, there has been a steady pickup in housing and government infrastructure projects, which resulted in reviving demand across the markets. Yet the industry is still facing certain issues which we will touch upon. In this webinar, we will briefly be discussing trends in production and capacity utilization, demand drivers, trend in prices, a bit of a financials on the industry basis, and quickly in terms of ratings also as to how we go about doing it. While we are on the subject of ratings, when we rate companies which are in a sector like cement, which is a commodity, 2-3 things which as an agency we will look at very closely. One is the cost structure, because you are in a commodity business, prices are given to you. You really cannot command prices in the market. There's not much of a product differentiation. So as a result, someone who has a good control on cost structure, a lean cost structure, or good operating efficiency, so to say, that particular company, that particular person is going to be the last man standing should prices keep on coming down. And then from that perspective, it becomes extremely important for us to analyze the cost structure and how what is really driving it, and what type of a control you have as an agency, as a company. Second is, it's also a cyclical industry, and as with cycles, you have peaks and troughs, and as a result, your so to say, your business risk is on a higher side. If business risk is on a higher side, for the same level of rating, we will want a financial risk, as indicated by leverages, to be on a significantly lower side. So these are some of the dynamics, that control and that dictate the ratings that we assign in a way in terms of our thinking. Having said that, let me quickly come to the sort of key messages that we are going to sort of bring out today, and my colleagues in their presentation will take you through the details of that. So a couple of points that we would like to make. One, industry has been recovering in a calibrated manner as against our initial estimate of decline in production of about 25 to 30% for FY21. We now see that number coming to only something like 10%, which is a good thing. Operating rates, uh, they are likely to be in the region of 50 to 55% against the initial estimate for 40-45% for FY21. Demand has remained strong, as I said earlier, in a rural and a semi-urban market, and going forward, government infrastructure projects thrust on that will certainly drive the demand for the product. Outlook for 22, and which is important in our opinion, it's sanguine. It's due to government thrust towards infrastructure creation. The union budget of 2021-22, the FM was very clear in terms of what really is going to drive the economy and infrastructure being at a forefront of it. So from that perspective, we believe that demand for cement is going to be really good as far as India is concerned. Third point, the prices somewhat declined in Q3 of FY21, but they are still higher than the previous year. And the higher prices coupled with lower cost, which sort of a rationalization you achieved as a result of various efforts taken by the industry during COVID period, that's resulting into a better EBITDA per ton. Though frankly speaking, power and the transportation cost is to some extent on higher side. And so these are some of the key points on which my colleagues Urvisha and Radhika will be deliberating upon. So here I'll stop and hand over to Radhika and request her to take us through the detailed presentation. Over to you, Radhika.
Thank you, Amod sir. Good afternoon, everyone. Let me begin with a brief overview about the industry. The world consumes around 4 billion tons of cement annually. And like said earlier, India is the second largest cement producer and consumer after China, with a production capacity of about 545 million metric tons currently. In terms of quality, technology, efficiency, India compares well with the best in the world. However, when we see the per capita cement consumption, for India, it's quite low. We are at around 235 kgs as against over 1500 kgs for China. The cement industry plays a pivotal role in the infrastructure development of the country. The industry growth rate is positively correlated with GDP growth rate of the country. It not only generates substantial revenue for central and state government, but it is also a key industry that generates maximum employment directly as well as indirectly. Unlike the global scenario, the Indian cement industry is highly fragmented with over 100 plus companies. However, in the past, we have seen a phase of consolidation that has happened in this industry. As of now, the top 20 cement companies account for around 70% of the total market. Ultratech leads with a capacity of 111.4 million metric tons, followed by the Holcim Group, that is the ACC and the Ambuja. Then you have the Shree Cement. When we see in terms of regional capacity, southern region leads, followed by north, east, west, and central. Majority of the plants in India are situated in the states of AP, Telangana, Rajasthan, and Tamil Nadu. The industry as such has been on a sustained growth path, adding capacity, which has largely been driven by the construction sector and various infrastructure project announcements made by the government. We now move to our next slide, wherein we can see the production and capacity utilization of the industry over the last 6 years. As we can see, the installed capacity of the industry has been increasing year on year over the last 6 years. Installed capacity of the domestic manufacturers has increased at a CAGR of 7.1% during FY16 to 20. Manufacturers have also been able to maintain a capacity utilization of above 65% in the 5 years ending till FY19. However, in 20, the utilization dropped primarily because of prolonged rains and the COVID pandemic that happened. So utilization dropped from about 70% during 19 to about 62% during 20. Domestic cement production has grown at a CAGR of 4.2% during FY16 to 20. Production as well as consumption declined once before in FY17. That was a year of demonetization, wherein you had the housing demand went down as well as the infrastructure spends were cut. Post that, since 2012, the production again declined last year, that is FY20. The outbreak of COVID pandemic in the Indian subcontinent forced governments to announce a nationwide lockdown, which affected the peak season, that is March, wherein the demand and production fell down drastically. production fell by almost 25% in March, this on 20 as compared to a growth of 16% in the previous year. In our next slide, we can see the monthly domestic production for the 9 months, that is April to December. Cumulatively, domestic cement production has fallen by 18.3% during 9 months FY21 compared to a growth of 14% achieved during 9 months FY20. The fall was steepest in Q1, wherein it was a decline of about 38%. This was primarily because of the lockdown, which impacted production and demand. However, capacity utilization of manufacturers has now gradually been improving. We actually see that utilization levels have improved from 40% in Q1 to about 45 in H1, which has now gone up to almost 49.5, 50% in the 9 months. Initially, because of the pandemic and the lockdown, manufacturers cut down or deferred capex expenditure given the fall in demand, and companies were basically trying to conserve liquidity and cash flows. But post the unlocking phase, capex plans are gradually picking up for various cement manufacturers across the country. Even with the center relaxing rules for unlocking the country, the industry faced challenges initially, but gradually the demand has picked up. Let's now look at our next slide, in which we can see the regional capacities of cement across India. As we can see, South houses the highest capacity for India, wherein it's almost 35% of the total capacity. This is primarily on account of huge limestone reserves present in this region. However, this region also has the lowest capacity utilization of almost close to 50-odd%. AP, Telangana, Tamil Nadu, Karnataka are the major markets in this region. Housing and infrastructure, especially irrigation projects, are the key demand drivers for this region. Next in terms of capacity is North, which houses almost 20% of the capacity. Infrastructure and individual housing are the key drivers for this region. Capacity utilization levels here remain moderate. East houses 18% of the total capacity. Owing to the high demand, the capacities of this region has increased over the last couple of years. Capacity utilization remained at around 65-66% in this region, primarily on account of rural infrastructure in the forms of highway project, power projects, etc. We now come down to West, wherein you can see that this region had about capacity about 14% overall, and the utilization here was about 68-69%. You have infra-led demand revival that happens that is supporting the demand for this region. Last comes Central, which houses about 13% of the total installed capacity. As the available capacity is less, this region has the highest capacity utilization levels for India. Let's now move to our next slide, wherein we can see the regional price trend for the cement industry. As we can see in terms of prices, the realizations have been highest in the Northeast region for the last 4 quarters at above rupees 400 per bag. Prices increased across regions during the June quarter, post lifting of the lockdown with the pent-up demand. In the December quarter, however, prices declined. This is primarily because although the demand has been increasing, it has not yet reached the level wherein it can sustain the supply without impacting the prices. Prices on an average were about 400 per bag in December in the South, about 390, 400. Then you had the East, which was around 337, 340 per bag. North was about 370, 375. West was around 350, 354. And Central was about 355, 358 per bag. So as we can see, the prices went up and then gradually declined a little bit, but have remained firm. I now hand over to my colleague Urvisha, who will take us through demand drivers for cement industry and financials.
Thank you, Radhika. That was extremely insightful. Moving on to cement demand. As explained earlier by Amod sir, cement demand is closely linked with the overall economic growth, particularly of the housing and infrastructure sector. Increasing demand from the affordable housing program, construction work for other government infrastructure projects, roads, metros, airports, irrigation are demand drivers which influence and support the demand. In terms of how cement demand has fared during FY21, which is our COVID pandemic year, so amidst the pandemic, cement consumption has grown and is supported by the rural demand. Due to better labor availability, there has been an increase in the construction of rural infrastructure and low-cost housing. Rural demand is usually with respect to the retail market and is again largely housing and repair works and modification of the houses. In the present scenario, as the economy has now unlocked, we are now seeing that there's been a steady pickup of the product going forward, given how housing and government infrastructure projects have again picked up steam. And it is resulting in revival of the commodity across all regions. Even post-monsoon, which is Q2, project execution has again resumed with the receding rains. Now, in the next few slides, I will be explaining a little bit about the particular schemes and policies which have been influencing cement demand. Certain of these schemes will be the ones which have influenced it in the past, and certain schemes we do see going forward, which will be influencing the commodity product. The first one, since we started off with how rural demand has been so exuberant and robust, I'll be talking a little bit about Pradhan Mantri Awas Yojana Gramin. So this is the Housing for All program aimed at providing the Pukka houses by FY22. Under PMAYG, each beneficiary is given approximately 100% grant of rupees 1.2 lakh in the plain areas, approximately 1.3 lakh in hilly regions, northeastern areas, difficult areas, Jammu and Kashmir, and among so far. So far, that is till February at least, 1.29 crore houses have already been built across the country in this scheme. Next up, we have the status of the projects under Pradhan Mantri Gram Sadak Yojana. This is a nationwide plan of India to provide good all-weather connectivity to unconnected villages. Again, better availability of labor has not affected the work of construction work. As we can see on screen, approximately 138.62 kilometers of length has been constructed up till 16th of February 2021. Now we move on to the urban infrastructure. First up, I'll be talking about the Pradhan Mantri Awas Yojana Urban, the Urban Housing for All program. This is basically to ensure the basic dignity of living for all. It was first launched in June 2015, and it aims to provide affordable housing to the lower middle class and mid-income groups, at least by FY 2022. That is the kind of target the government has provided. In the current financial year, the FM had also allocated an additional outlay of rupees 18,000 crore over and above the budget estimates of 2021, which was earlier rupees 8,000 crore. The following announcement is to help complete real estate works of the program in the affordable housing segment. It is also to help start work of 12 lakh houses as well as complete 18 lakh houses to provide 78 lakh thousand jobs and also improve the demand of steel and cement. National highway development. Construction of national highway development has recovered tremendously in the current financial year, considering how Q1 all the activities were washed out. In Q2 was a monsoon month. So Q3, that is October onwards, we've been seeing quite a good resumption of these activities. This is also because of the pace of construction has become much better. We can attribute this to a resumption of the roads of all the awards given under the EPC model, and to an extent also of the road award of the HAM model. As we can see, on a pro rata basis, we have seen that 29.8 kilometers is the pace of construction in the current financial year. Moving on, we have the National Infrastructure Pipeline. That has been quite the scheme the government is extremely proud about and keeps talking about in almost all their plans at the moment. It was introduced on December 31st, 2019, and it is to provide world-class infrastructure across the country and to improve the quality of life of our citizens. It aims to provide project preparation, attract investments, both foreign and domestic, into the infrastructure. And it will be crucial for the country of targeting of becoming the 5 trillion economy by FY 2025. As mentioned earlier by Amod sir, a little bit about the budget push which the FM has just announced, which is again in line with the NIP program. This budget has announced at least a good 26% increase in the capital outlay program, and it is also the much needed push which needs towards the infrastructure development, towards housing, roads, and urban infrastructure. The last part I think I'll be discussing about is the financials, extremely important. We have analyzed approximately 30 cement companies out here, and as Amod sir mentioned earlier, it is an extremely natural resource dependent industry and highly energy intensive. Natural resources like limestone, coal, and minerals are essential to produce cement. The industry needs to ensure the continuous supply of these particular materials to make sure the optimum cost and quality is produced. A significant factor which aids to the growth of this industry is the availability of limestone and coal. Now, Q3 is an actually extremely important quarter for this industry, considering the fact how Q2 is a monsoon quarter. So not a lot of work is gotten done in there. So Q3 is more of a pickup quarter for the cement industry. Due to various cost rationalization measures and overhead cost controls undertaken by the manufacturers, as we can see, there has been an increase in the overall operating profit margins, net profit margins, and the interest coverage ratio. The overall sales revenue has also increased by 15.2% in Q3 FY21, and this has even though the sales have declined by 4.5%, it has been taken across by the total expenditure falling by 9.6% in 9 months. The increase in sales can be attributed to the uptick in the real estate activities in Tier 2, Tier 3 cities, which was initially very downbeat and had languished and was showing no signs of recovery. But given the fact of the low-cost interest regime and the different SOPs provided by the government towards developers and home buyers, we are seeing an uptick in these in the real estate sector. Also, rural demand can be attributed to the better top-line numbers. And lastly, in Q3, we also see that the housing and infrastructure projects have also picked up steam. This is also again attributed to increasing the top lines of cement manufacturers. Overall expenditure has, however, increased by 6.1% in Q3 FY21, but overall in the 9 months, it has declined by 9.6%. This 9.6% decline is mainly because of the different negotiations the industry has put forward with their contractors and their suppliers, and because of the fall of the total expenditure in these 9 months, it has made sure that the top line numbers have also been sustained. Lastly, it is very important for any cement manufacturer to know the key input cost trend. The same 30 companies, we are seeing the costing which has happened to them in Q3 FY21 as well as on the 9 months basis. If you can see, selling and distribution expenses, which is also known as the freight expenses, your electricity, power and fuel, and the cost of raw materials, all of them account for approximately 65 to 66% of the total overall expenditure in the current financial year. We can notice that the electricity and fuel expenses has increased by 11% after months of subdued oil prices. During Q3 FY21, petcoke prices have increased by 12.8% due to limited availability and increase in demand from Latin America and the Mediterranean. In fact, the current trend we can see and we've been noticing is that many cement producers have been trying to switch over from petcoke to coal, which is also having a high calorific value and is cheaper to use in comparison to the latter. But coal prices have also increased by 1.6% during this quarter due to the production and logistics disruption, strong Chinese demand, and winter demand amidst ban of coal in Australia as well. The logistics cost in the cement industry has increased by 12.6%, by 17.9% rather in this quarter, and this can be strongly attributed to the increase in diesel prices. However, it has declined by 4.4% in the 9 months, and this could be because of the account of renegotiation of contracts, the network optimization, and logistics efficiency. Raw material cost has, on the other hand, increased by 11%, even though limestone costs have declined. This is also because probably the increase in the cost of fly ash and gypsum. Thank you. With this, I would now like to hand over the webinar back to Radhika, who will be discussing a little bit about the ratings aspect. Over to you, Radhika.
Thank you, Urvisha. We'll now be having a look at the factors impacting the credit profile of cement players. Firstly, we have the geography and the market-related factors. Considering the bulky nature of cement, the value-to-volume ratio is adverse for cement, and hence it's largely influenced by the regional demand supply rather than a national demand supply. So companies which have multi-locational units and pan-India presence are superior in terms of credit perspective. Then we have the operational strengths. Companies with advanced systems resulting in production economies are preferred. New plants are preferred over old plants due to low operating costs. When it comes to raw material, companies having plants near the limestone reserve with long-term mining rights ability are preferred, and the ones which are able to source raw material from open market at competitive prices. Another important cost driver is power and fuel. So companies having their own captive plants, operating on low cost or easily available fuels, or manufacturing units set up in low power tariff states have an edge over the others. Also, plants which can use multi-fuel types are more cost effective. As Urvisha earlier pointed out, companies which are shifting from petcoke to coal are making profitable compared to what it was earlier. Then we have locational economies. Of late, a lot of companies have split location plants, wherein the clinkerization unit is next to the limestone reserve, whereas the grinding units are, within the proximity of the end user market. By adopting this strategy, companies basically can minimize their freight costs, which is another major cost driver for cement companies. Then we have branding, which is more or less a fairly new concept, but it helps companies command a price premium. It also helps them maintain their market share during a bad phase. So which companies investing in advertising, marketing, extensive dealer network to create a brand recognition promotion benefit from this. Again, your product mix is also important. So blended cements, having a larger share of blended cement, adds up to your margins because your costs go down. Again, capacity expansions. So with increased capacities, you enjoy economies of scale. So that obviously gives you a better credit in terms of credit perspective. Management quality is again a vital role, and government. The industry is still susceptible to government actions like a ban on sign mining, price freeze pact, etc. So all that always comes into place. In our next slide, we'll touch upon the challenges that the industry is currently facing. First and foremost, the major challenge is the labor issue. With the reverse migration that has happened due to the COVID pandemic during the first quarters of the financial year, this industry was impacted severely. But post the festival season and Q2, it started picking up and laborers have been returning. The staggered shifts because of the pandemic also impacted this industry. As pointed out earlier, increase in fuel prices, especially petcoke, has been impacting the margins of cement players this year. The high logistic costs with the increase in the diesel prices also have a bearing on the industry, and the low capacity utilization levels. The industry even now has an average of about 60% or 65%. So it's always been a challenge which cement continues to face. In our next slide, we'll actually be looking about the CARES rated universe. CARE actually has about 22 cement companies that we rate. Majority, as we can see, are in the investment grade. That is about 17 out of the 22 are under investment grade. And below, one, we have a AAA, then AA majorly is you have 9 companies. In our next slide, we'll see the transition over the last year. So typically in the industry, we have seen only 1 downgrade in the previous year, 3 upgrades, and most of them have been retained. With this, I would like to conclude my part and handing over to you, Amod sir. Thank you.
Thanks, Radhika and Urvisha. That's pretty insightful. So now we get into a discussion with Mr. Saraogi, and I'm glad he's able to join back. I mean, initially I think there was some trouble with his computer. So let me quickly run through his introduction once more. Mr. Saraogi is a chartered accountant and he's a CFO of Birla Corp. Birla Corp is a flagship company of MP Birla Group. Prior to joining Birla Corp, he was with the Indian associates of firms such as Ernst & Young and BDO, where he served several clients including ITC, Bharti Airtel, Lafarge, Peerless, iGate, and Reliance Communications. Welcome, Mr. Saraogi. Thanks for joining us here in this event. I think you're on mute, possibly.
Am I not audible?
Yes, you're audible now. So really thankful for joining in today, Mr. Toshniwal. As I said earlier, he could not make it, but that's okay now. So Mr. Saraogi, we had certain. I thought I'll touch. You are from the industry, and I'll touch base some issues and take your point of view before we move to a Q&A with the audience itself. So. One point that I want to discuss with you was, though the situation seems to have improved for the cement industry, and it's now 11 months since the COVID-19 disruption. So, do you see some challenges still persisting, or are we all good now? So, what are the challenges that industry still faces, in your opinion, on a practical side?
See, one of the challenges which was cited in the presentation was low capacity utilization. but that is more of a region-specific phenomenon. So the regions which we are operating in, which is primarily North, Central, and East, that is not a challenge really. The operating rates are pretty high. The only challenge we are facing in the regions that we operate in our business is the fuel price. So just to give you a sense, the pet coke prices, currently the FOB prices are $120. A year back, they were around $70. The landed cost is also higher by about 40%. So that has become a bit of a challenge, and especially since the companies, as of now, have not been able to pass through the cost to the customers.
Yeah, yeah.
Yeah, and even the diesel prices, consistent increase will eventually lead to higher logistic costs.
So yeah, and with the crude against, at what, something like 65 to a barrel.
Absolutely.
For last, I think, it's sort of a peak for, if you look at last couple of quarters. So that seems to be a challenge. So and petcoke also, I believe, will be closely linked to crude in terms of pricing, right?
No, it is independent of crude, but there
Yeah.
it is more of a demand supply
Okay.
mismatch. The demand is much higher than the supply.
Okay. In terms of prices, what's your view? The levels that we see now, you think that we'll be able to hold, or there's going to be pressure?
See, currently the prices, at least in the regions that we operate in, they are on an average down sequentially by about 4%. And even on a year-on-year basis, they are down between 2 to 4%. North is slightly better. North is probably down by about 1%, but East and Central, there is some pressure in the price. So the average uh, gap compared to last year will be between 2 to 4%. But in the month of February, the companies are trying to at least raise the prices in certain pockets where the demand is strong. And going forward, given the background of the increased input costs and the fact that we expect a healthy healthy growth in demand, I feel the pricing power should be very much there with the cement companies, and it should be just a matter of time that the input costs are passed on to the customers.
Okay, so that's good to know. So that will sort of help you maintain the profitability.
Yeah, it may not happen immediately. So in this current quarter, there might be some pressure, which may be compensated by the increase in volumes.
And rural and semi-urban saw good traction even during pandemic and subsequently. So you during say FY20 to 23, you expect that to sort of continue?
Absolutely, but in the coming year, given that it's going to be expected to be an investment-led economy, we expect a large demand coming from infrastructure sector as well.
Okay. And maybe last one from my side. All commodity players, be it cement, be it aluminum, be it iron, I think those who sort of take care of their balance sheets during the good times by deleveraging and so on, generally they are able to face the difficult times much better. So do you think industry has, as an industry, not your company as such I'm asking, but as an industry, have they tried to do that? We saw this happen to the cement companies way back in 6, 7, 8 or so, during which a lot of companies significantly delivered good times. They use cash to pare down debt and so on. So how will you compare, how will you comment on this issue in present times?
See, in my view, most of the companies in the cement industry, they are not very highly leveraged. So they have been fairly disciplined in terms of leverage. So I don't see that. Whatever few companies were there, they have been transferred either through NCLT or otherwise. And as an exception, you would have found that those companies have generated fairly decent valuation also.
Yes, that's true. So and actually, that's good thing about, by asset you can sort of sell and parcel out if need be so, and so on. So great. I think that was few of the points that I wanted to sort of touch upon. So unless Urvisha or Radhika have something to comment or ask, otherwise we can throw the discussion open to a Q&A from the audience side. Mrudul, are you there? Yeah.
Actually, I think we do, Radhika and I do have a certain questions we want to ask ever since we've been tracking this industry. Mr. Saraogi, I want to know, given the whole cost, how it's been working out. Initially during Q1 and Q2, we could see that the costing was sustained because the commodity prices were also down. But now since the economy has been opening up and the cost price has gone up, we saw especially of pet coke and of diesel, which is affecting the fuel and logistic cost. How do you see the realizations going forward then?
Realization, as I said, should definitely improve. With better demand, the operating rates should also improve. So the companies should have adequate pricing power to pass on the price increase or cost increases to the customers. They would like to protect their margins, right? So I expect the prices to gradually firm up from where they are currently.
Yeah.
Okay.
Great. So if Mrudul is there, maybe we can. Mrudul, are you there? We can throw the discussion open for a Q&A. Or Urvisha, if it's so what possibly we can do is maybe request the participants to queue in the type in the questions in the window provided for questions, and maybe once we get that we take it up. Maybe we take a break of 2 minutes when they sort of type in, and that's how we do it. Yeah. So if once you start getting questions there, Urvisha, maybe we can start that part.
So we do have questions actually.
Yeah.
This is from Mr. Saraogi. It says, how does
from whom it is? It will be nice if you can read out.
Mr. Bijay Kumar, he's asked how does he view aggregate capacity utilization panning out, and what's his view on the next phase of capacity expansion?
The average capacity utilization should definitely increase with a sharp increase in demand, which is expected in the next financial year. So I think the average capacity currently is around what, 60%?
Approximately.
Yes, it's around 60%.
Yeah. On 60, so definitely should increase by at least 200 to 300 basis points. That would be my sense. And cement is one industry which has always been on expansion spree, and I don't see any exception to that in the times ahead also. So whichever companies have mineral concessions available, which is becoming quite a constraint with in the new regime, where you can only bid for them in the auction, and not many auctions are happening. So the companies which are having existing mineral concessions, they would definitely like to monetize the concessions and grow their capacity.
Okay. I have a question from Mr. Sanjay Shah, and he wants to know, does the budget have anything positive for the cement industry?
100%. It has got all the positives, given that it is a infrastructure-led there's such a huge infrastructure push. So we expect very robust demand coming in from infrastructure sector. See, typically the demand growth in cement ranges between 0.75, 0.8 to 1.1, 1.2 of the GDP growth rate. Given that we are now going to have a investment-led GDP growth, at least in the next financial year, the multiplier factor should be close to 1.1, 1.2. So that itself is going to be quite conducive to the demand of cement.
All right, thank you. I have the question for next. I think Amod sir and Radhika, both of y'all. What's the pricing scenario in central and northern regions? And another question would be from how is the cost trend going to be in 2021-22?
The
Okay,
pricing
so
scenario,
yes,
Yeah,
you can
Mr.
continue,
Saraogi.
yeah.
please.
So not currently the prices on a year-on-year basis will be slightly down by about 1%, and in the central region they would be down anywhere between, let's say, 2 to 5%. Going forward, given the high operating rates in both these regions, I expect the prices to firm up. Especially in view of the rising costs, I expect the prices to firm up gradually.
All right, I have one question from Mr. Rohit Dalal. Will the slump in residential demand for housing affect demand for cement?
No, in fact, on the contrary, we find green shoots in the real estate sector. So that should in fact further aid demand. So that has been a factor which has been missing all these years. So that also should gradually come back. That
So you
is
do.
what my, yeah, it should be
Yeah, I mean, yeah, he's right. I think that's what I think we also hear on the ground in terms of, possibly the real estate sector after maybe in a way a downturn of almost a decade or so is seeing green shoots and demand is really showing signs of perking up. That's what we hear. We hear that the risk officers of bank who are dealing in retail loans for housing are super duper busy these days. That's what we actually hear. I mean, someone who assesses the proposals, they're pretty busy. So looks like. I mean, it's early to say. We also speak to we rate a lot of real estate companies and large one at that. We also hear from them that they are also now very hopeful. Frank, okay, I mean, to the extent that it is coming from their side, it's a sort of a being an interested party, but no need to discount that point of view totally. And it comes from fairly respectable, large listed real estate players. So frankly speaking, the the sort of a slump would be a very strong word now to use. Possibly, as Mr. Saraogi also alluded, I think we are in the initial phase of real estate sector on a residential side. Also now looking up slowly and steadily. I mean, very initial days, initial phase. And nothing has. It is really not as yet started reflecting into real estate prices and so on and so forth. But at least proposals and an interest that people show, that's what we hear. I mean, that's what we actually see. And some of the things, I'm sure you do research, and some of the growth that we are talking about, I think all this has to lead to that, including work from home and so on and so forth. Some of those things, I mean, I don't know, drivers, I mean, you guys know some of those
I
much
think
better.
another factor which is driving which will drive the demand is the low interest cost. The interest cost, for example, the housing loan interest costs have never been so
Yeah.
low.
Mm-hmm.
Yeah, yes. So I think
That's
all
also
things
much.
considered over the life of the asset, I think that's very, and looks like interest cost while interest rates can move up and down, but we are in fairly benevolent interest rate regime. That's how it looks like. So very true, Mr. Saraogi. Yeah.
So I have a question from Mr. Siddharth Dant. He says, does a little bit of higher leverage make sense for cement companies in the current low interest rate environment?
So I'll answer that. I mean, if you're asking from an industry point of view and a rating agency point of view, and Mr. Saraogi can give the owners or the manufacturers perspective, but as far as rating agencies are concerned, and you know the fundamental principles, the first principles that drive the the conceptual issues as far as ratings are concerned, they remain same: good times, bad times. Otherwise, we will not be able to sort of rate the companies over the cycles and as sort of apple to apple comparison, so on and so forth. So if leverage is going to be higher, purely on that count, it's a negative. I mean, you say that I'm 0.2x vis-a-vis I'm 0.5x. 0.5x is clearly a negative. Now to say that, because there are good times and some of the challenges that come as a result of 0.5x can be addressed, and if we believe that by the time that the cycle turns and things become somewhat adverse, this 0.5x is really again going to come back to 0.3, 0.2, or so on and so forth, possibly. But all things considered, higher leverage is the issue, and more so with the commodity plays, more so with the cyclical plays. Mr. Saraogi can throw light on that.
I don't think interest costs per se have a major impact on the investment or capital allocation decisions. And as it was discussed, the interest costs are cyclical in nature. Today they are low, tomorrow they'll be high, and it's not always possible to have a fixed cost, fixed interest rate loan. So majority of the loans from banking sector are variable, linked to MCLR. So you can't really link your investment decisions or even your borrowing decisions with the interest rate cycles.
Okay. I have a question which says, how much would be the cost unit difference between green energy and traditional energy? This question is from Mr. Parth Bhavsar.
What was the question?
What would be the unit cost difference between green energy and traditional energy? I think when it comes to manufacturing for cement players.
So cement players, if they use green versus the regular energy.
Yes.
Green energy are of two types in cement industry. One is, of course, the wastage recovery, which basically generates power from the wastage which is generated from the kiln. So the variable cost or the marginal cost of power from wastage recovery is less than a rupee. And the other major source of green energy is solar power plants, which we know probably ranges from 3 rupees to maybe 350, that sort of a range. And if we compare this with the cost of power from the utilities, which I think that will range anywhere between 6 to 8 rupees, depending on which state you are operating on. So that will be the kind of difference in power.
Okay. I have a next question from the ratings perspective. It's from Mr. Ketan Parekh. He wants to know, in CARE, can we expect more upgrades if things turn around sharply next year?
Yeah, so okay, let me answer that. And I guess this is not only for cement industry possibly that you're asking. If things turn up sharply next year, and if they sustain, okay, because 1 year uptick or a 2 year uptick is frankly speaking not good enough from a long-term rating perspective. So if things do show a good growth and a sharp uptick, and we believe that the change is for good and for long term, then certainly yes. I mean, it will have a clearly a sanguine effect as far as the ratings are concerned. So to use Urvisha's word, but yeah. So that's what it is. If the correction that we think is a long term or sort of a permanent in nature, it will clearly start reflecting in ratings. No doubts about that.
Okay. I
mean, ultimately in the ratings, what are we looking? We are looking at ability of the corporates, of the commercial businesses, to generate a level of EBITDA with less volatility that is going to be good enough for debt servicing. That is what all that we are trying to analyze. EBITDA levels, how much you can report that, what sort of a volatility you can you'll have in that, and vis-a-vis that, what type of obligations you have. This is all, frankly speaking, we do all our expertise goes in predicting the right amount of EBITDA that operation cash flows will throw up, Are we going to see a stability in that quarter on quarter and year on year, or we'll have a huge volatility? If it's going to be volatile, what are the peaks and troughs that we will see? And during the troughs also, are you going to be in a position to be good enough to repay the debt obligations, both interest and principal or not? That is all frankly that we do. And as a result of overall good, strong economic momentum, if things start looking good, yes, then it has to reflect in ratings very clearly.
Okay. I have two questions actually, which are concerning capacity. One question is,
so I think, just before that, I think maybe these are last two questions.
yes, the
by
last
5
two
we need to
questions.
close. Yeah, possibly. Yeah.
Yeah, so one of the question is new capacities are coming in central region. How competitive is the scenario? And the other question is, in the next 5 years, what do we see capacity built up to be like?
I think that Mr. Saraogi, to the best of his ability, he can answer that. Yeah.
Currently, the operating rates in central region will be in excess of 90%. And central region is one region in the country which is growing at a very high rate. Both Madhya Pradesh and particularly Uttar Pradesh, there's a lot of growth which is happening. So we expect a new capacity to be absorbed by the incremental demand, and we don't really see that as a challenge. As of the questions regarding new capacities coming in next 5 years, frankly, I don't have the data as of now.
Okay, I think that's great. So I think, frankly speaking, with this we'll have to sort of stop because of the paucity of time. I'm sure there will be more questions, and whoever needs to ask can please key in their questions or mail across to us, and we'll try our best to revert back with our answers to that. With that, I'd like to thank Mr. Saraogi for taking out time in his busy schedule and agreeing to be a guest speaker here. I'd like to thank all the participants for attending this webinar. I'd like to thank my colleagues, both Urvisha and Radhika. With that, you can log off, and then thanks a lot. A good day to you. Thank you.
Thank you to the care team for having me on board. Thank you.
Thank you, sir. Thank you.
Thank you,
Thanks a
sir.
lot. Thank you.
Thank
Bye.
you.
So Urvisha, you can switch off then. Yeah.
All right. Yeah.